Subscribe to the channel and press the bell icon to never miss any updates. Every time when we read newspaper, when we watch videos regarding finance, when we see social media post, what often you see is CAGR, which is compounded annual growth rate. That means the returns that you are seeing in television, social media post and newspaper, most of the time CAGR, which is compounded annual growth rate, is mentioned. Therefore, it is critical to understand what is the meaning of compounded annual growth rate, and if we manage to understand this, understanding return on investment would become a lot easier. So without any further ado, let's get started. The compounded annual growth rate is one of the most accurate ways to calculate and determine return on investment over the long period of time. Basically, it allows investors to calculate and compare return on investment between two different type of asset classes, or the same asset class but two different things. For example, if you want to compare the return on investment of two different mutual funds, you can simply compare compounded annual growth rate, which is CAGR, of the two funds, and here you go. If you manage to compare the CAGR of the last 10 years of both the funds, you will get to know that which fund is best for you. Similarly, if we talk about stocks, if you want to compare the two stocks, how the stocks have been performing, you can simply go with CAGR method rather than annualized method and absolute method. So this is how you can leverage CAGR, which is compounded annual growth rate method, to compare and finalize that which investment instruments you are going to go. When it comes to mutual fund, it is the most common mutual fund return used when a fund's performance usually seen for longer holding periods. While annualized return is generally used to convert less than 1 year returns to an annual return, CAGR is used for longer periods to give compounded annual returns. CAGR considers to start and end the value of the investment and the period concerned, while normalizing all high and lows of the investment during the period. One important point to note is that CAGR does not consider periodic investments or multiple cash flows. Therefore, if there are multiple investments in a year at irregular dates, CAGR may not provide a good picture. In this type of particular scenario, you would consider leveraging annualized return rather than CAGR. CAGR works best on a point-to-point basis where we are considering one-time investments. So after saying me that one-time investment, you would think that I'm talking about lump sum investment, right? Lump sum investment is there, yes, you are correct. But one-time investment also includes that SIP, which is systematic investment plan. That means you are consistently investing your money in any particular fund, any particular mutual fund, any particular stock for a longer period of time, and on the same date you are investing your money. So let's say if you stay invested, if you keep investing your money for 10 years, on every first date of month you are investing your money. So you can calculate the return of investment using this method. There is no problem with that. So this is what you need to understand regarding CAGR. It is widely used method, and I recommend you to leverage this method for calculating the return on investment. So we have covered three types of return on investment. The first, we discussed about absolute return. Second, we discussed about annualized return, and third in this particular podcast we covered compounded annual growth rate, which is CAGR. So what's the conclusion over here? Well, After knowing all these measures, there are a few things to be kept in consideration. When evaluating an investment or even mutual fund's performance, one must not be misled by a return figure in an isolation. One must always compare apples to apples. The period, the measure, and the product categories being compared should match. A good understanding of how to evaluate returns can assist in evaluating and making investment decisions. However, it is widely known past returns are only indicative in nature and may or may not sustain in the future. In any investment decisions, returns are just a small part of it. Other factors like risk, liquidity, investment horizon, taxation, and more importantly, personal factors like risk appetite, investment objective and requirement, etc., are more critical to evaluate. An understanding of all these factors, not just returns, is important to succeed as an investor. So, yeah, that's it for this podcast.